Hi, in today's class, we're going to learn the concept of financial leverage or trading on equity. What is financial leverage? It is the usage of borrowed funds, which is also known as debt, in your capital structure. This helps in improving your earnings per share. So in today's sum, we're going to learn about three alternatives that are available for a company, wherein they can raise extra finance in the form of equity, debt, or preference. And I'm going to prove to you on how, when you use debt in your capital structure, it leads to improving or increasing your earnings per share. So let's look at a sum. So in this problem, ABC Limited has currently all equity shares consisting of 15,000 equity shares of rupees 100 each. Now, this is the existing equity that the company has. The management is planning to raise another rupees 25 lakhs to finance a major program of expansion and is considering three alternatives for this. Point A, or first alternative, to issue 25,000 equity shares of rupees 100 each. Second alternative, to issue 25,000 8% debentures of rupees 100 each. And the third alternative, to issue 25,000 8% preference shares of rupees 100 each. So these are the three alternatives in hand. Which alternative should the company choose in order to raise this extra 25 lakhs that they need? The company's expected earnings before interest and tax is rupees 8 lakh. Corporate tax is 50%. Now we are supposed to find out the earnings per share in each of these alternatives, which will then help us find out which alternative is the best. So let's open the income statement. We're going to have three amount columns, which indicates the three alternatives that we have in hand. Since they've given us the earnings before interest and tax, our income statement of ABC Limited will start with EBIT, that is earnings before interest and tax. The amount given to us in the question is 8 lakh. So I'm going to mention 8 lakh in every alternative. Now we will be finding out about how each alternative is going to have an impact on this EBIT and then show us what is the calculation of EPS or how much EPS we get in each of these alternatives. So the first thing we deduct once we arrive at our earnings before interest and tax is the interest on debt. Now over here, the debentures are in the second alternative, issuing 25,000 8% debentures. So interest will not be applicable in the first alternative where they are raising equity or in the third alternative where they are raising preference. The interest will be applicable only in the second alternative, that is 8% debt. The 8% indicates the rate of interest. How do you calculate interest on debt? You take the rate of interest and multiply into the amount of debt. Now we already know that 25 lakh is being raised in each of the alternatives. So 25 lakh will be the amount of debentures, or another way of finding out the amount is take your number of debentures 25,000 and multiply into rupees 100. So we have the amount of debentures 25 lakh and we have the rate of interest which is 8%. So we are going to take 25 lakh and multiply into 8%. That gives us the rate of interest. Once you deduct interest, the next income is called as earnings before tax, which is also known as taxable income. In the first alternative and in the third alternative, there won't be any change. But in the second alternative, after you've deducted tax, your taxable income, after you've deducted interest, your taxable income will reduce to 6 lakh. Now, this is the major advantage of having debt in your capital structure because your taxable income is going to reduce to the extent of interest that you've paid to your debenture holders. The next step is deduction of corporate tax. The corporate tax given in the question is at 50%. So we are going to calculate 50% on our taxable income, which is also known as the EBT, earnings before tax. So 50% on EBT will give us 4 lakh, 3 lakh and 4 lakh. This will then give us earnings after tax. 4 lakh, 3 lakh and 4 lakh. The next step is deduction of preference dividend. Now this calculation is very similar to the calculation of interest on debt. Firstly, which is the option that has preference in it? It is the third option. Therefore, the first option and the second option will have no preference dividend calculated. So in the third option, we take the amount of preference, which is 25,000 into rupees 100, that's 25 lakh, into the rate of dividend, which is 8%. 25 lakh into 8%. That gives you 2 lakh. The next earnings that you get will be known as earnings available to equity shareholders. In the first option, it's 4 lakh. Second option, 3 lakh. And in the last option, you get 2 lakh. So with this, you finished your income statement by arriving at the earnings available to equity shareholders. Now, what is the intention of preparing this problem? We are finding out what will be the earnings per share in each of the alternatives. And whichever alternative gives us the highest EPS, that's the alternative the company should choose. So in order to calculate EPS, we need to know the formula. EPS is earnings available to equity shareholders divided by number of equity shares. So let's find out what are the number of equity shares in each of the alternatives. Now, when you're calculating the number of equity shares, always remember to check if there are any existing equity shares in the company. Now, I started off the problem by saying ABC Limited is currently an all equity shares consisting of 15,000 equity shares. So we need to remember that currently there are 15,000 equity shares in the company. So whether the company goes for option A, B or C, the 15,000 equity shares is still existing in the company. So therefore, in the first option where they are raising extra 25,000 equity shares, we'll have to add the existing 15,000 to this. So in the first option, the number of equity shares will be existing 15K plus the new 25K that is being raised. In the second option, the number of equity shares will only be the existing 15,000 because in the second option, they are not raising any new equity shares. And the same thing happens in the third option. Since they are not raising any new equity shares, it's only the existing equity shares that we will have to take into consideration. Now that we have our EAES and our number of equity shares, we will be able to calculate our EPS. So EPS is going to be 4 lakh divided by 40,000. That's 15,000 plus 25,000. Rupees 10. In the second option, it's 3 lakh divided by 15,000. And in the third option, it's 2 lakh divided by 15,000. So now you will be able to notice the EPS that we have earned in each of the cases or each of the alternatives. So it's clear that the second alternative, which has debt in it, is the one that shows the highest EPS. And this is why having debt in your capital structure is going to be beneficial for your firm. With this, we've proven the concept of financial leverage. Also remember that you can't have too much of debt in a firm or in a capital structure, because with more debt, the amount of interest that you end up paying is also going to increase. Unless and until you can guarantee that you have enough earnings to cover this interest, don't raise too much of debt. Because if you do that, then you will end up having something called as financial risk. So remember, shortage of funds to meet interest obligation is called financial risk. So remember, you cannot have too much of debt. At the same time, have some amount of debt, because it's definitely going to give you the tax advantage and improve your EPS. Thank you.